critical engineering segment constituting aerospace, defense, space engineering, hydrocarbon, marine and a few others requires equipment and assemblies to pass through certain sustainability tests to check if they are averse to rust and dust, pressure, temperature, moisture as well as durability issues and many other parameters. Grauer Weil is a dominant player in the surface finishing space. Many of its paints and surface coatings are meant especially for the longevity of ships and are anti-fouling, which were earlier imported and approved by the DRDO and other organizations. They have specialized coatings for oil and gas pipes and other applications with approvals from the US and the Europe. Started as a chemical production company in 1957, it ventured into paints with the acquisition of Bombay Paints in 1994. Today, with a niche-focused strategic acquisition, know-how and building capabilities through R&D, it has not only emerged as a dominant player but also ensured durability and sustainability of the business and its earnings. It caters to most of the industrial and critical needs of industries. This is precisely the reason in the last 2 years, the company had suffered in terms of growth and profitability. Furthermore, while 88% growth comes from the surface finishing segment, its other two segments, engineering and real estate, had a major impact leading to pressure on profitability. However, this is now stabilizing. In the first 9 months of this fiscal, the company has reported a 40% year-on-year growth in revenue led by a recovery in demand as economic and industrial activities picked up. More than that, with higher scale, profitability has also improved with EBITDA margins now at 17.4% in the 9 months period of this fiscal, an improvement of about 79 basis points. The other notable thing is that the company has faced many business cycles in the past and its strategy to command the market, maintain a strong balance sheet and prudently run business has passed the stress test caused by COVID-19. The cash in the business and the strong control over working capital have kept the company in good health. It is sitting on a cash of about 254 crores, which is close to 50% of its net worth or 20% of the current market cap. In the first 9 months of this fiscal, the company earned other income of close to 9.3 crores. While a strong balance sheet helped protect the downside, recovery is expected to drive earnings and valuation. Valuations are currently below the long-term average. The last 5 years' average price-to-earnings ratio is around 18 times, while the stock is quoting at 14 times its trailing 4-quarter earnings. Growth in earnings is crucial. With the recovery in most segments it operates in, it's expected to post good earnings growth over the next 2 years. In the first 9 months, if you look at it, net profits have already grown 51% YOY. Margins are expected, however, to remain under pressure in the medium term, but given the leadership and growth in the segments that it operates in, that should not be a worry. The overall earnings trajectory for the next 1-2 years looks good in light of the capex in the user industry and government focus on capacity augmentation. The stock has made a high of around 71 rupees in July last year. Thereafter, it did correct more so in the last 1 month as a result of the crash in mid and small cap stocks. At the current market price, the stock offers a good value, trading around 14 times its FY22 estimated earnings. The valuation also looks attractive from the perspective of recovery in earnings, market leadership, cash in books, and also the quality of earnings.